Over the better part of the past 12 months, we've spoken quite a bit about the impacts that interest rates have on the overall economy, asset valuations, and honestly just investor sentiment overall, which realistically shouldn't be that much of a surprise as we've seen firsthand the impact that low interest rates have on the stock as well as the real estate market over the past 2 years. And this comes at a time when inflation is at the highest level that we've seen since the 80s, right? As we can see from this chart, average inflation across the US has reached 7.9%, which, I had mentioned in a previous video that I absolutely believed we continue seeing inflation rise past the 7.5% that we saw in January. And realistically, this figure could continue to rise and stay at very high levels over the course of 2022, which is very difficult for everyday consumers. So at this point though, let's consider that the Federal Reserve really doesn't have any other option than to start raising interest rates gradually in order to try and tame this out of control level of inflation while also avoiding completely halting economic growth across the American economy. Now, you might remember from a couple of months back, I released a video speaking about the Fed's plan to, start raising interest rates over the course of the next couple of months and years, and that contained a multi-step strategy and also several rate hikes up until 2024 on a sort of dot plot chart, and well, that plan has now commenced, so we need to talk about this in today's video. Hey, what's up everyone, it's Griffin here, and I hope you're all having a great day. By the way, I just want to put this out there, I currently have a cold, so that's why I might sound a bit under the weather and nasally, but anyways, after months of anticipation towards the Fed actually raising interest rates over time, well, now it has actually commenced, where the American Federal Reserve has indeed approved the first interest rate hike in now more than 3 years, December 2018 to be exact. And this is really significant because increased interest rates do have direct impacts on the economy as well as the markets, just like we've seen the opposite of over the past 2 years when rates were near zero. So as we can see here, since March 2020, the Fed dropped down rates to 0.25% in order to stimulate economic growth in the face of the pandemic. And it stayed there for the better part of 2 years until this past week where the Fed approved a 0.25% rate hike, which now sits at 0.5%. Now, a 0.25% interest rate hike, you might be asking yourself, what exactly does this mean for everyday individuals and investors? Well, quite simply, this has a direct impact on the prime rate that banks and other lenders are going to use in order to issue out consumer loans. So typically, say a bank is going to issue out a personal line of credit at the prime rate plus a certain percentage for the borrower's total rate. So this basically means that over the next couple of years, it's going to get more expensive to borrow money for all purposes, from credit cards, personal lines of credit, mortgage, and so forth. Now, this 0.5% interest rate hike isn't much in the big picture, but let's consider that the Fed can't just simply raise interest rates by 1% out of the blue. This would totally destabilize the market. So it's somewhat of a balance and also stable increments over time. However, it is expected that we'll be seeing 6 more rate increases by the end of the year, bringing the consensus funds rate to 1.9%. And for now, the Fed also expects 3 more rate hikes in 2023 and none the following year, meaning that by the end of this entire rate hike cycle, we should be seeing rates at around 2.5%, which would put us at around the same rates that we experienced just before the pandemic. But really, that's just a guess, and if inflation does continue to rise rapidly, it really wouldn't be out of the question if we see the Fed increasing rates at a quicker pace, but then also by larger increments at a time, based on reasons that we'll be discussing shortly, even though this could definitely have a shock on the financial system. The question really though is, will these interest rate increases be enough to materially counter the high levels of inflation that we're experiencing, while also allowing though for continued economic and GDP growth, which of course we do want to continue seeing? Well, historically speaking, the Fed tends to lower interest rates in order to further stimulate economic growth, as lowered financing costs tends to encourage further borrowing and investing. But what ends up happening is that when the rates get too low, as we've experienced over the past 2 years, well, this can very well lead to excessive growth and, well, subsequent inflation, which reduces purchasing power and undermines the actual sustainability of the economic expansion in question. I mean, at the end of the day, inflation aside, let's not forget the insane level of asset growth that we've experienced in both the stock market as well as the real estate market since the March 2020 lows. The S&P 500 expanded by over 100%, and many markets added 30 to 70% value to their real estate, which is almost never before seen in such a short period of time. So essentially, when it's cheaper to borrow, not only do consumers utilize more debt, but so do businesses in order to further fuel their own growth and expansion, which really just creates an environment of larger output and productivity. On the flip side, when it's more expensive to borrow, which is the reality that we're going to be faced with over the foreseeable future, well, this leads to consumers purchasing less goods and services. And so demand tends to end up dropping, which should have an impact on decreased inflation. One of the most striking examples of this was back in the early 80s, where inflation was at 14%, and the Fed raised interest rates to 19%, which caused a severe recession, but it did end up putting an end to the crazy inflation that the US was seeing. So all this to say that with interest rates on the rise over at least the next 2 years, we should expect this to, yes, have an impact on taming inflation, but then also decreasing economic growth pretty much across the board. This would actually be a great time to speak about today's video sponsor, Upstart. So I often speak on the channel about the importance of, first and foremost, ridding yourself of any outstanding high interest debt, specifically credit card debt, before moving on to building your emergency fund, let alone investing, as credit card debt is just so financially crippling now, but also over the long term. So this is actually where Upstart would come into the picture, where they've now worked with over 1 million people to help them consolidate and ultimately pay off credit card and other forms of high interest debt in a way that allows for fixed monthly payments and a clear payoff date that actually feels realistic. Taking a look at Upstart's website here, we can see that they offer multiple different services to choose from, and actually getting approved for a loan comes down to more than just your credit score. In fact, Upstart considers a variety of different factors, including your income as well as your employment, to make sure you're getting a smarter rate. Now, if you're ready to take action towards ridding yourself of your high interest debt with Upstart, it's as simple as filling out a form to check your rate without impacting your credit score in just 5 minutes, and this is for loans between $1,000 and $50,000. So make sure to find out how Upstart can help you lower your monthly payments today when you go to upstart.com/milks or click the top link in the description. That's upstart.com/milks, and don't forget to use the top link down below to let them know that I sent you. All right, let's get back to the video now, speaking about how this can impact the stock market, right? We're investors here, and with interest rate hikes impacting the economy, well, this is going to undoubtedly ripple over into the stock market. In fact, we've already been seeing this with investors already pricing in these expected rate increases ahead of time. That's definitely something that is interesting about the stock market. Sentiment and overall investor emotion can lead to upwards and downwards movements in the broad market and individual positions. So even though we have been seeing the broad market bounce back over the past week or so, this definitely does not mean that the bleeding has fully come to an end. At the end of the day, it's easy to forget that the stock market is made up of actual businesses that operate in the economy, and many of these businesses utilize debt capital to further expand and grow. So of course, an increased cost of borrowing also negatively impacts the bottom line of many companies, especially unprofitable companies to begin with. Now, that being said, the Fed actually expects business growth will continue to slow down for the rest of the year at around 2.8%, which happens to be down from the prior forecast of 4% growth. So really, even though it's already been extremely rough over the past year or so for many tech and smaller cap companies that are unprofitable and also utilize a lot of debt capital to fuel their growth, well, I kind of think that this is going to continue unraveling over the foreseeable future, at least until we're seeing these interest rate hikes stabilize in the market, right? Because even though the market has already started pricing in these rate hikes over the past couple of months before it even started happening, well, if the Fed decides to increase the rates at a much quicker pace or by larger increments, this could absolutely have a destabilization effect on the market of driving it down further. Now, that being said, does this mean that you shouldn't continue investing in the stock market over the course of this year and next? No, not at all. Always remember that it's completely normal to see periods of slowed economic growth and valuation growth throughout the course of a long-term investment approach, granted that the funds and your asset allocation are suitable to your investor profile as well as your risk tolerance. I'm simply going to continue doing what I've been speaking about for years on the channel and doing myself as an investor, being dollar cost averaging into broad market, low-cost index funds that allow me to average into the market and ride the growth of the American economy over years to come. Now, what about the impacts on the real estate market, right? I've been speaking a lot more about real estate investing on the channel because it's something I've been doing a lot more of in real life, and I've also been speaking about it a lot on my TikTok. Make sure to follow me there if you don't already, posting daily multiple different clips about questions people have, as well as other topics about real estate investing and just investing in general, really. Well, I'm not going to dive into all the details around what impacts the real estate market, but of course, interest rates does have an impact on this somewhat, right? If you want to learn more about my thoughts thoughts around the real estate market and how raising interest rates could potentially have an impact on lowered or at least stabilizing the real estate market over the next couple of years, make sure to check out the video that I'm going to be overlaying right here. Now, the bottom line is that as investors, we should absolutely be expecting the markets to be somewhat choppy over the next year or two, as all of these factors are tugging at the market and trying to be priced in, especially following such a large market rally that we saw over the course of last year. So make sure to leave me a comment down below letting me know how you think these interest rate hikes are going to impact the stock market and the overall economy this year and next. If you enjoyed today's video, make sure to drop a like. It really helps the channel grow, and also consider subscribing, hitting the bell button to be notified of new and upcoming stock market, real estate, and overall just personal finance content as a whole. Also, don't forget to check out Upstart. There's a link down below in the description. So with that said, thanks a lot for watching, and I'll see you in the next one.